Hello, Alexander Green here, Chief Investment Strategist with the Oxford Club. And I want to remind you that if you haven't subscribed to this channel, please do. That way you won't miss any of my updates on anything that's happening in the markets and the economy that would affect you as an investor. Today, I want to talk about a topic that's become really what everybody is talking about, which is this rip-roaring bull market. Has it turned into a bubble? There are reasons for thinking that it may be. I mean, obviously, if you look at valuations in the stock market, for instance, the average company in the S&P 500 is trading for 28 times trailing earnings. The market has never traded at that high a valuation since the dot-com bubble. And there's other signs of froth. You look at some of the meme stocks, which I warned you about back early in the year, and yes, they've come down substantially, and I think they still have further to go, but they're a clear sign of a little bit of over-enthusiasm about the stock market. I looked at what's happening in the crypto space, and especially with the ridiculous Dogecoin, a joke digital currency that's useful for absolutely nothing, that had a market cap of $90 billion a few months ago, more than Ford Motor Company or Marriott International. But is the stock market itself a bubble? My answer is no, it is not a bubble, and there's a very good reason for that. Yes, stocks look expensive based on trailing earnings, but you have to remember those earnings are depressed because of the pandemic. A year ago, people were at their wits' end, thinking that the economy was going to collapse and we were going to have this pandemic, and we weren't even sure if we were going to have effective vaccines. We all know that that's not the case now. Second quarter earnings are up much more than analysts expected. They expected a 78% increase in second quarter earnings. Second quarter earnings so far are up 92%, a 92% year over year increase. Now, part of that's because of easy comparisons to a year ago during the lockdown, but the momentum is building in the economy. We have ultra low interest rates. We have maximum stimulus from the Federal Reserve and from Congress. Stocks are currently selling at about 20 times projected earnings for the next 12 months. And what is the average projected earnings of the S&P 500 for the last 50 or 75 years? 20 times projected earnings. But for the last 50 years or so, we didn't have the rock bottom interest rates we have now. When you look at valuations on a forward basis instead of a trailing basis, you can see stocks aren't that expensive. And what is the alternative to stocks? I think stocks are still the best place to be. And it doesn't mean that the market can't sell off suddenly. That can happen at any time. But you protect yourself not by running to cash, but by diversifying outside the stock market in real estate investment trusts and gold shares and high yield bonds and high grade bonds and inflation adjusted treasuries, and then also by running trailing stops behind each of your individual stock positions. That way, as long as it's trending up, you continue to be a shareholder. If it flattens out and starts coming down, your profits don't slip through your fingers. They're protected by your stop order. So that's the smart way to handle a potential down market. But we're not in a classic bubble. The market can always sell off. That's a given at any time for reasons that you can't know in advance. But stock valuations as such are not so overvalued that you would call this a bubble. So that's it for today. I want to remind you that you can sign up for all of my views at Liberty Through Wealth, my daily e-letter. It's absolutely free, and I encourage you to do so. But that's it for today. Thanks so much for listening. Alexander Green. I look forward to talking to you again soon.